Thank you so much for joining. In this video, I would like to give you a quick introduction to alpha and beta in finance. Two very important measurements in regards to measuring risks in finance. Very important beta. One measurement is about sensitivity to market, which means it's a measurement for systematic risk. That's a risk that we learned in another video that cannot be diversified, and it affects all stocks. A higher beta means higher volatility relative to the market. So if a company has a higher beta due to volatility of sales, financial leverage, or operational leverage, that means the company affects more or is more affected by market fluctuations than a company with a lower beta. Yeah, higher beta, higher volatility to the market. Alpha, however, measures the excess return beyond market expectation, which means it measures idiosyncratic, individual, firm-specific risk. This can be diversified. So we assume we are not only investing in one company, we are investing in a portfolio of company, and then what happens on firm-specific individual risk level does not matter too much because we assume we have a well-diversified portfolio. Positive alpha means the stock or the share or the company that you have invested in has performed better than what our expectation would have provided. Expectation, I will come to this, how to calculate expectation, but a positive alpha basically means the individual stock has performed better. Very important, if I look at beta, if you own high beta stocks, you see more drops compared to the market, and if you own low beta stocks, it will drop or fluctuate less. Idiosyncratic risk, it's also called specific or unsystematic risk, and it's unique to one company. Let's do an example. So first, that's the formula for beta. Covariance return specific return, company return, return market, and then the variance to market. So what it means is return of the stock here, market return here, for example S&P 500, and variance market return here as well as S&P 500, and it gives you an indication how much your stock moves with the market. What does it mean? If a stock A has a beta of 1.5%, that means if the overall market moves by plus 10%, then we would expect that stock R is moving plus 15%. If stock B, other company, has a beta of 0.5, then if the market moves by plus 10%, then we would assume the company share fluctuates less and would only move plus 5%. Yeah, so it gives you an indication about stock movements and fluctuations. Alpha, however, tells us how much extra return a stock or portfolio generates compared to what its beta predict. You may be familiar with this formula. This is our formula CAPM, cost of equity or return equity, risk-free rate beta, market risk minus risk-free rate. And then this is our expectation. And then if our return of the stock performs better, then our alpha is positive. Yeah, so for example, if we use market return 8%, risk-free rate 2%, beta 1%, then we can calculate our expected return, which is this one, expected return. That return of this company would be 2% risk-free plus 1.2 times 8% minus 2%, and this would give us 9.2%. But then if we see that the company actually returns 12%, that is the actual return that we can observe, then we know our alpha equals 12% minus 9.2% equals 2.8%. And then our alpha is positive, and we can see that the fund manager or the asset, the company, or if we look from a portfolio perspective, has generated an extra 2.8% return beyond what is expected. Yeah, so very important, beta market-driven risk, uncontrollable, alpha stock-specific performance. And if you combine both types of risks, just to close the loop, both types of risk is measured by standard deviation. Total risk or by variance is the same, but these are the parts that make up risk. Thank you so much for listening. I hope you found this useful. I see you in another video. Bye bye.